Hello, everybody. Thank you for joining me today in today's webinar about IRS innocent spouse relief and how to request penalty abatements. Before we get on to today's content, I'd like to tell you a little bit about myself. For those of you who don't know me, my name is Vinar AR. I am a tax attorney in Michigan and the founder of AR Law. My firm specializes in helping resolve problems with the IRS for individuals and businesses alike. Any kind of issue somebody might have with the IRS, we are the people to help resolve it. Anything from unpaid taxes, unfiled returns, defending IRS audits or criminal investigations, defending tax preparers and accountants against allegations of misconduct, any kind of issue you can think of somebody might have with the IRS, I'm the guy to help. Another thing you should keep in mind is you are all welcome to use me as a free resource in your practice anytime the need shall arise. Feel free to call me anytime with any questions related to solving tax problems. If you have a client that has a situation with the IRS and you're not quite sure what steps you need to take to get it resolved, just pick up the phone, call the number on your screen. That is a special hotline set up just for accountants and attorneys who want to ask me questions, and I'm always happy to help free of charge. Ask me anything about today's content or anything else related to tax problem resolution. So without further ado, we're going to move on to today's content. And this session is going to be about innocent spouse relief along with how to get penalties waived with the IRS. We're going to go over in three different sections. First, we're going to talk about an overview of innocent spouse relief. Then we're going to go over an overview of IRS penalties. And then we're going to talk about tips and specific instructions on how to get penalties waived. So what is innocent spouse relief? What are we talking about? Innocent spouse relief refers to relief from joint and several liability for one spouse or the other. What I mean by that is when two spouses file a joint return, they are both responsible for the full amount of the tax due. This is known as joint and several liability. When a spouse signs a joint return, they are liable for the tax shown on that return and any additional taxes due based on an audit or other assessment that might occur later. So when you sign a return jointly, you're on the hook for that year, not just for what's on the return itself. Also, under community property laws, if you live in a community property state or were married in a community property state, you can be held liable for your spouse's taxes, even if you guys don't file jointly. So innocent spouse relief refers to getting one spouse or the other off the hook on joint taxes. It's claimed by filing a Form 8857 with the IRS. Now, innocent spouse relief is not to be confused with injured spouse relief or injured spouse allocations. Injured spouse relief refers to when two parties want to file a joint return and one spouse owes the IRS money and the other spouse doesn't. You would do an injured spouse allocation in order to allocate the refund. So injured spouse deals with when there's a tax refund due and one spouse has a separate IRS debt, you try to allocate the refund between the two spouses so that way the government can't take the whole thing. Innocent spouse doesn't deal with refunds. This deals with what happens when taxes are due for that year. Two separate things, but they're often confused because they have kind of similar-ish names. Another thing to keep in mind when you do innocent spouse is that the IRS will always contact the other spouse or former spouse or other spouse if they're still married. Make sure your client understands this. Because the other spouse is harmed by the granting of the innocent spouse, remember they owe this taxes together, and it's in each spouse's best interest for the other spouse to pay. So when you request innocent spouse, you are asking for something that would harm the other spouse. Therefore, they have an opportunity to participate in the proceedings. There are no exceptions to this. even for if victims of spousal abuse or domestic violence, the IRS will always notify the former spouse of your claim and allow him or her to participate. They'll let them know of any preliminary or final decisions. They can disclose all information about the application except for quote-unquote personal information. For example, current name, address, phone number. If there's anything you're concerned about getting out, anything private that your client does not want their spouse or former spouse to know, be sure to make necessary redactions to the documents before you send them to the IRS. Anything you send in connection with the innocent spouse application, assume will be shared with the other spouse. And if you don't want them to see it, make sure to make appropriate redactions. Now, under Section 6015, which establishes innocent spouse, there are 3 separate grounds for relief. The first one is under Section 6015B. It's known as innocent spouse relief. Then there's something else known as separation of liability relief. That's under 6015C. And then there's another grounds for relief known as equitable relief, and that's under 6015F. All 3 of these taken together are commonly referred to as quote-unquote innocent spouse, even though only one of them is technically innocent spouse relief. Now, there are 4 situations in which you cannot claim innocent spouse relief. First is if a court already considered whether you qualify and you lost. A court usually refers to the United States Tax Court, but not always. Or if a court did not consider innocent spouse, but you meaningfully participated in a court proceeding and had an opportunity to ask for innocent spouse and failed to ask for innocent spouse, then that will preclude you from asking later. If you entered into an offer in compromise, now we're not talking about applying for an offer in compromise. We're talking about actually, settling your debt with the IRS and you agree to make pay a certain amount. You can't do innocent spouse later. Or if you entered into a closing agreement, which is a contract with the IRS to settle a tax debt, you sign what's called a closing agreement. And if you sign one of those, then you can't later ask for innocent spouse relief. So, what is innocent spouse relief? The first type of relief we mentioned, which is 6015B relief. There are 5 requirements that must be met to be granted innocent spouse relief, and we're going to talk about all 5 of them. The first is you must have filed a joint return. There must be an understatement of the liability. You have to lack actual or constructive knowledge. The innocent spouse must be the equitable result, and there's a 2-year deadline. Those are the 5 requirements. We'll talk about each one of them. The first is the filing of a joint return. Innocent spouse relief is only available for people who filed joint returns. If you did not file a joint return, then you do not need innocent spouse relief. Okay? If the innocent spouse signed a return under duress, the signature was involuntary, therefore it is not a valid joint return. Or if one of the spouses signed on the other spouse's behalf, you can just argue and you want to get out of it. You don't need innocent spouse relief. You just need to argue that the other person signed the return without your permission, and therefore you never even filed a joint return. If you didn't file a joint return, you're not jointly responsible for the taxes, so you don't need innocent spouse. If you want to claim duress, you have to prove 2 elements. One is that you could not resist the demand to sign, and 2 is, but for the duress, you would not have signed anyway. The next requirement is there must be an understatement of liability. Innocent spouse relief is not available if you sign a return that shows the correct amount of tax. That is because when you sign that return, you agree that you owe that tax. What we're dealing with when we're talking about 6015B relief is when the return is wrong and either has unreported income or incorrect deductions, credits, or basis. And then the IRS will audit the return, and now you want to claim that you should not be held responsible. So this only applies for returns that were filed wrongly. If the return was accurate and the taxpayer did not pay the full amount due, then no innocent spouse relief is available. although equitable relief might be available in certain underpayment cases. The understatement of liability must also be attributable to the other spouse. If it was your income that was left off the return, don't go and claim innocent spouse later. You're not going to get very far. It has to be the other spouse's income that was left off the return. You also have to show that you did not have actual or constructive knowledge of the return's inaccuracies. A plain reading would make ignorance of the law a defense. If you don't know that the returns are wrong, if you know all the numbers on the return, but you think that there's a law that allows those deductions, then that is a defense to a lack of constructive knowledge. However, the courts have used a knowledge of the transaction test. They have not read it the way that I just described. What the courts have said is that if the spouse has knowledge of the transaction or has reason to know of the transaction or the item that was reported incorrectly or omitted from the return, then they will fail the knowledge requirement. Okay? You don't have to know the return was wrong. You have to know about the item that was omitted. Just knowledge of the transaction. When it comes to erroneous deductions, the test is if a reasonably prudent person could be expected to know that the return contained a substantial understatement. So if looking at the return on its face, it's obvious that it's probably wrong, those deductions are probably not legitimate, spouse should know a little bit about the financials, then they can say that you had reason to know or that you had actual knowledge. Also, you can't have, continuing on with the actual or constructive knowledge. Constructive knowledge means reason to know. There are a number of factors to look at. It's a facts and circumstances test. On your screen, you see just a few of them. They look at the totality of the circumstances, including the nature of the erroneous items, financial situation of the spouses, level of education, involvement in financial affairs, presence of lavish lifestyle expenses or spending patterns compared to previous years, evasiveness or deceit concerning finances, failure to ask about items that a reasonable person would question. That's what it all really boils down to. If there are certain red flags that you should have picked up on and didn't ask about, then that can be used as reason to know. And then another requirement is you have to request innocent spouse relief within 2 years after collection activity begins. Collection activity usually refers to the issuance of the first notice of deficiency or notice of delinquency or collection due process notice of intent to levy. There is an exception for decedents. If you're claiming innocent spouse relief on behalf of somebody who is deceased, then you apply the 2-year rule as of the date that they died. Not as normally it's as of the date you apply for innocent spouse. It has to be within 2 years. But when it comes to dead people, as long as the 2-year window was still open at the time of their death, then you can still claim it. Common issues with the 2-year limit: there's no discovery rule. Oftentimes spouses will hide collection notices from the other spouse. It doesn't matter if you actually knew that the IRS sent the collection notices or that the IRS began collections. All that matters is that it actually happens. So that brings us to our first polling question of the day. Okay, moving along, the next type of relief out of the 3 types is called separation of liability relief. This is under 6015C. Now, what this is when the IRS would apportion a liability resulting from understated tax according to the spouse's income and assets. Basically, you ask the IRS to split your debt from your spouse, hold them responsible for their issues, and leave you be on your issues. This is only available if the claimant does not qualify for traditional innocent spouse relief. The IRS has to look at innocent spouse relief, and then only if you don't qualify, then they can consider separation of liability relief. Usually, when we're doing a separation of liability relief, the reason they didn't qualify for innocent spouse is because they failed to pass the knowledge test. There are 6 requirements for requesting this type of relief. Some of them overlap with innocent spouse relief. Some of them are new. So the 6 requirements are: it must have been a joint return. You still have the 2-year deadline. There must have been an understatement of tax. Those are the 3 repeaters, and they're treated the same in this relief as they are for innocent spouse relief. The 3 new requirements is you must no longer be married or be separated for at least the last 12 months at the time of filing the claim. The 12-month rule does not apply where you're no longer married. It only applies to separation cases. You must not have actual knowledge. Notice I didn't say constructive knowledge. Only actual knowledge applies in separation of liability relief. That's why oftentimes people can't meet the constructive knowledge requirement of innocent spouse. You ask for separation of liability relief. Now, there is even an actual exception to the actual knowledge requirements in cases of spousal abuse. If you knew about it but couldn't say anything for fear of your safety, well, that is not a disqualifier. And the 6th requirement is you must not have culpable conduct. That's defined as tax avoidance, interspouse transfers, fraudulent conveyances, stuff that is quote unquote shady on the part of the requesting spouse will disqualify you from relief. So now this is a flow chart that the IRS has available as part of Publication 971, which deals with innocent spouse relief. It is just a kind of a handy, quick reference guide that kind of goes through all of the requirements and determines if you qualify to ask for innocent spouse relief or not. So the 3rd and final type of relief that you might ask for innocent spouse relief is called equitable relief. Now, under equitable relief, the main requirement is just that it would be inequitable to hold the requesting spouse responsible for the tax. That is the underlying theme of all the innocent spouse cases. If I had to sum up innocent spouse in one sentence, I would say what innocent spouse is they'll let you off the hook on a joint return if you could convince them that it would be unfair to do otherwise. Equitable relief applies to understatement and underpayments. Even if the return is 100% accurate, then they can use equitable relief. It is a facts and circumstances test. So one example of an underpayment case, I had a taxpayer who was separated from his wife. They were still legally married, but for financial reasons, they chose to file jointly. And he prepared the returns, and the return on its face showed that there was a balance due. So this is not an issue where the return was wrong. The return showed that they owed like $200,000. However, he told his spouse that he was mailing a check with the return, so she'd sign it, and then rather than mail the check with the return, he would just mail the return without a check. And it turned out he had a gambling problem, didn't tell her about. So now she signed the return, and there was nothing wrong with the return, and the return on its face showed that she owed the money. However, because of his misdeeds, we were able to successfully argue it would be unfair to hold her responsible in those circumstances and got her off the hook. That is a textbook case for equitable relief where you don't qualify for anything else because there's no understatement of tax. Then you just have to prove or convince the IRS that it's just the fair thing to do. Now, there are 6 threshold conditions in order to be able to claim equitable relief. Now, the first one is you can't be eligible for innocent spouse relief or separation of liability relief. The IRS likes to look at these in order, so they go down the list, and you can only go down to the next one if you don't qualify for the previous one. We're still only talking about the filing of joint returns. If the requesting spouse had made any fraudulent transfers or any transfers that were part of a fraudulent scheme, not just fraudulent with respect to taxes, if they defrauded anybody, if there was any transfers of property to avoid tax, there can't have been any knowing participation in the filing of a fraudulent return, and also the liability that you're requesting relief from must be attributable to the non-requesting spouse. You can't ask for equitable relief and say it would be unfair to hold you responsible for taxes on your own income. The debt that you're asking relief from has to be attributable to the other spouse. But as long as you meet those 6 conditions, then the IRS will look at the totality of the facts and circumstances to try to determine what the fair thing to do would be, or equitable thing to do. Equitable is just a fancy lawyer talk for the word fair. Now, some of the factors they'll look at if there's a legal or practical divorce or separation. The length of the separation, conditions, the permanency are all relevant, but there's no specific bright line rules like there were with the separation of liability relief. They'll look at significant economic hardship. If they don't let you off the hook, would that leave you unable to pay your basic living expenses? They'll look at the other spouse's obligations to pay under a court order. Usually when people file for a divorce or when they have a divorce order, it'll say who's responsible for the taxes. IRS is not bound by those agreements, but they will look at those agreements as a factor in determining whether or not they should let you off the hook. Now, that's not relevant. A lot of times when people get divorced, they just agree that whoever is least able to afford to pay is responsible. That's not good enough. If you know that they can't pay when the divorce decree is entered, then the IRS won't consider that as a bonus point, to let you off the hook. They still might let you off the hook. It's not a disqualifier, but it doesn't help you. Now, if you were abused, that can help you. That is what's known as a one-way factor. If there was physical or mental or emotional abuse present in the relationship, that can help you. But a lack of abuse does not count against you. Obviously, that's what it means to be a one-way factor. Also, poor health is another one-way factor. If you're in poor health, that can help you get innocent spouse or equitable relief. But if you're in good health, they're not supposed to use that against you. But by far, the main, most important factor in determining whether it would be equitable to hold you responsible is if you derived a significant benefit from the non-payment of tax, they will almost always hold you responsible. Okay? A significant benefit from the non-payment of tax means any benefit in excess of normal support. So if your client was living large and traveling the world and, on their yacht, meanwhile the spouse was cheating on their taxes, the IRS can deny innocent spouse or equitable relief on the grounds that you derived a significant benefit. You would not have been able to live lavishly but for the non-payment of taxes. Therefore, even if everything else is true, at the end of the day, you got the benefit. They're not going to let you off the hook. Now, keep in mind, that doesn't mean that rich people automatically disqualify. What if your spouse was making $1 million a year and reporting $1 million a year? But actually, and based on their reported income, you can easily afford to live your lifestyle, but actually they were making $10 million a year. And, they were taking that money and sending it overseas and squirreling it away or doing something. All you have to show is that even if they paid their taxes, you would have still been able to afford this lifestyle. Then that's okay. That only comes in if, but for the non-payment of taxes, you would not have been able to live the lifestyle or see the benefits. Compliance, good faith effort to comply is very important. They're going to look at that. Constructive knowledge is a factor that they look at in equitable relief, but they are very explicit to state it's not any bigger of a factor than any other factor. It's not weighted very heavily. On the other hand, actual knowledge is considered a very strong factor weighing against relief. But notice it is just a factor. It is not a disqualifier. It can be overcome if all the other factors in favor of equitable relief are particularly compelling. Like with the separation of liability relief, there is a flow chart available in IRS Publication 971 that kind of runs through all the factors or all the conditions for relief. Okay, so now really quickly, I'm going to show you guys what an actual 8857 form looks like and how to actually request innocent spouse relief. This is the form. It's 8857. It's got numerous pages. It starts by asking information about the taxpayer, information about the tax years. It goes over the debt, and then it's going to ask a series of detailed questions about why you think the spouse qualifies for relief. It'll go over many of the factors that we discussed in question and answer format. After you fill out this form, you might feel like you've told the entire story, but it is important that in addition to the form, after it goes over all the factors and all the facts and the details, it'll also cover the taxpayer's financial condition, because remember, one of the things they look at is ability to pay. So you fill in the financial detail, you do everything. At the end, there's space for a statement. Where that statement goes, you should always attach a statement. You should write in that space, "See attached," and do a detailed legal memo that not only goes over the facts of the case, but also goes over the requirements for innocent spouse and the different factors, and makes the argument for why your taxpayer qualifies for relief. Much like we're going to talk about shortly in penalty waivers, you don't want to just give them the facts and hope they came to the same conclusion you did, which is that your client qualifies for relief. You need to give it to them in writing, explain to them why you think your client qualifies. Go through all the qualifications and all the factors and make a discussion about it all and convince them to grant relief. That's it with the overview of innocent spouse. Moving on to talking about IRS penalties. Now, the purpose of IRS penalties, why does the IRS penalize people? A, it encourages voluntary compliance, it deters non-compliance, and it prevents non-compliant taxpayers, non-compliant filers to becoming compliant in the future. Important thing to remember about penalties that was reminded to all of us recently in the Grave case is that manager approval is required for penalty assessments or for discretional penalty assessments. It doesn't apply to audit. Some penalties are just automatically assessed by the computer. For example, a late filing penalty. Managers don't need to be involved in that, but manager approval is required for any accuracy related penalty or any human assessed penalty. If you can show that the manager approval was not obtained in advance of the penalty, then you can get the penalties thrown out. That's what the United States versus Grave versus United States case was, GRAEV, a very monumental tax court case. Very interesting. Common types of penalties you deal with: failure to file returns, could be an information return or an income tax return; failure to pay on time; failure to deposit on time, with payroll taxes or paying estimates. And then there's also accuracy-related penalties for filing returns incorrectly, and fraud penalties. Those include negligence penalties and also fraud penalties. There are also preparer penalties, 6694 for understating a taxpayer's liability. 6695 deals with other assessable penalties with respect to the preparation of the returns. 6701 is aiding and abetting the understating of a tax liability. It's a civil penalty. 6713 is disclosure or use of confidential information by preparers. The IRS can also ask for an injunction to stop preparers from being able to do returns in the future. Besides the 6694, which is the willful understatement penalty, the 6695 has a whole slew of penalties, including all the ones on your screen. There's most of these are anywhere from $100 to $2,000 per return as a maximum penalty. And that brings us to our next polling question. Okay, so moving along, next thing we're going to talk about today is how to actually get penalties waived by the IRS. Now, there are a couple different ways to do this. The first way and the easiest way is through what's called the First Time Abatement Program. Under this program, there are 3 requirements. First, the taxpayer must be subject to one of the specified penalties for the first time on a single tax return. And the taxpayer must have filed all required returns, and the taxpayer must have either paid the tax or made arrangements to pay the tax due. If you meet these 3 requirements, then the IRS will do a courtesy first-time abatement for the penalties for the failure to file and failure to pay, failure to deposit penalties. Those are the specified penalties, and the abatement applies to your first-time offense. First-time offense doesn't actually mean what it sounds like it means. It doesn't literally have to be your first offense. It just needs to be your first time in 3 years. As long as your taxpayer has 3 years in a row of no penalties, then they will qualify for a quote-unquote first-time penalty abatement on the 4th year. It doesn't matter if they actually had penalties in the past or not. And first-time abatements can be requested over the phone. That's usually the easiest way to do it. You pick up the phone, call the IRS practitioner hotline, or call the Department of Collections if your client's in collections, and you just ask them to waive the penalties as long as you've already met all 3 of the conditions. Now, when it comes to first-time abatement and reasonable cause, they're 2 separate and distinct concepts. They don't waive penalties for the first time because of reasonable cause. They're not saying that a first-time failure to comply automatically establishes reasonable cause. No, those are 2 different things. First-time abatement has nothing to do with reasonable cause abatement. And it provides relief for, like I said, there's 3 types of penalties that qualify for first-time abatement. Those are failure to file, failure to pay, failure to deposit. If you're dealing with another type of penalty other than one of these 3, then you cannot get first-time abatement for your client. But that does not mean that you can't otherwise get the penalties waived. The other way to get penalties waived is using what's called reasonable cause, which reasonable cause refers to a form of penalty relief that allows the IRS to use their judgment in providing relief from a penalty that would otherwise apply. It is based on the facts and circumstances of each individual case. It does not apply to all penalties, but it does apply to most penalties. It applies to a lot more than just the 3 types of penalties that are listed for the first-time abatement. So pretty much anything, any penalty that the IRS assesses against your client, or almost any penalty, will qualify for reasonable cause relief. So what is reasonable cause? When it comes to filing and payment-related penalties, then reasonable cause exists if you can show that the taxpayer exercised, quote-unquote, ordinary business care and prudence. When you're dealing with accuracy-related penalties, penalties imposed for filing your return incorrectly, then reasonable cause exists if you can show that the taxpayer made a good faith effort to report the proper tax liability. Reliance on erroneous 1099s or other information returns would generally constitute reasonable cause. If somebody sends you a 1099 and the 1099 turns out to be wrong, and you report the number on the 1099 on your return, then that, and it turns out to later be wrong, that by itself would usually be enough to constitute reasonable cause. They will take into consideration the taxpayer's experience, knowledge, and sophistication, and they will also consider reliance on advice of a tax professional. So, like I said, when it comes to filing and payment-related penalties, reasonable cause exists when you can show that the taxpayer exercised ordinary business care and prudence. So let's talk about what that means. Ordinary business care and prudence is defined as what a reasonable person in that specific set of circumstances would do. If the taxpayer followed the law as they understood it, then generally you can say that they exercise ordinary business care and prudence. Any reason that establishes ordinary business care and prudence, but was unable to apply, would be enough for a reasonable cause waiver. This, again, is a facts and circumstances test. So the question is, what are the facts that they would look at? Under the Internal Revenue Manual, there are 5 things that the IRS is supposed to consider when they're trying to determine if somebody exercised ordinary business care and prudence. What happened and when did it happen? What circumstances prevented the taxpayer from being compliant? For example, not filing returns, not paying taxes, making deposits. How did those facts and circumstances result in noncompliance? How did the taxpayer handle his or her other affairs during this time? And then once the facts and circumstances change, what attempts did the taxpayer make to comply? This is probably the most important factor. If you claim that you couldn't file returns because of illness, and then you got better, and you still didn't file your returns for 2 more years, well, that's going to weigh heavily against you, because they're going to look at, once the facts and circumstances changed, i.e. you got better, how long did it take you to comply? What attempts did you make to comply once whatever was prohibiting you from complying to begin with goes away? Now, what are the factors? What are they actually looking for when they look at those 5 things? Well, they're looking at the taxpayer's reason for noncompliance. Dates and explanation clearly correspond with the events on which the penalties are based. They look at the taxpayer's compliance history, i.e. the overall history of the taxpayer, whether they have a habit of filing and paying late or whether they've always been on time, but for isolated incidents. Keep in mind that first-time penalty abatement applies only to 1 year. So when you talk about compliance history, you want to show that this is the first instance of noncompliance, but it could be multiple years. You could have got sick and didn't file 3 years in a row. Well, it's the first time you were late generally, but first-time abatement would only apply to that first year. But reasonable cause might apply to all 3 years. So you talk about the compliance history before you got sick. Then they look at the length of time between when the event that prevented compliance happened and when the taxpayer became compliant. Like I said, if you get better and then just wait 3 years for no good reason to become compliant, then they're going to consider that heavily against you. Then the other thing they're looking for is to see if the circumstances were actually beyond the taxpayer's control or not. You can't complain that you were unable to file when the circumstances were caused by you to begin with. You usually want to look at things that are beyond the taxpayer's control to use as your reason for non-compliance. So requesting reasonable cause, although you can do it over the phone, it is best done in writing. You're better off, you should be writing a reasonable cause letter, which is a formal request to abate the penalties based on the reasonable cause criteria. Make sure that when you write it, you phrase it like a legal memo. Frame it in a way that fits with how the IRS is going to look at the situation. I've seen a lot of reasonable cause letters, and I've seen a lot of them done wrong. The typical way most people will write a reasonable cause letter, by nature, most accountants will write a reasonable cause letter. It'll go something like this. It'll say, "Dear Mr. IRS, please waive the penalties for my client because this, that, and the other thing happened. Sincerely, Mr. CPA." And then they'll send it in and keep their fingers crossed that the IRS will read their letter and read all the different things that happened and decide to grant your request. While that might work sometimes, that is not the right way to write a reasonable cause letter. These are legal writings. They need to be written like legal documents. They need to be written like persuasive arguments. Legal letters have various parts. Okay? The structure of a proper reasonable cause letter, in my opinion, contains 5 sections. The first section is the introduction / request for relief. Dear Mr. IRS man, please waive penalties for my client for these years for failing to file on time. And then the next section will be a statement of facts. These are all the different things that happened to my client during that time period. Notice these 2 sections were in my incorrect reasonable cause letter. That's usually what an accountant will do, is they'll do section 1, section 2, and section 5. But the most important parts of the letter are sections 3 and 4. Okay? A proper legal argumentative letter will contain a statement of law. In that section, you need to remind the IRS what it is they should be looking at. You need to remind them what is reasonable cause, what is the definition of reasonable cause, and not only should you be reminding them of the definition, you should be highlighting the sections of the law or the Internal Revenue Manual that help your case the most, and you should be downplaying or omitting the ones that don't. When I say statement of law, technically, the Internal Revenue Manual is not law, but that's what we're talking about here. You state the rules. In your letter, you say, this is what reasonable cause is. This is what the definition is. These are the facts. These are the factors. You can get all of that from the Internal Revenue Manual. Part 20.1.1 deals with penalty relief. Cite that. Find the paragraphs that help you the most. If there's an example that closely fits your fact pattern, put the example in your statement of law section. If there's an example that hurts your fact pattern, obviously do not put it in. And then after your statement of law, then comes your most important part, which is the analysis, aka the application of the law to the facts. When you write the statement of facts, you need to present your client's story in the best possible light, but you're not making argument, you're just telling the story. Section 4 is where you start to make your argument. You start to call back to your statement of facts. And it's kind of a blend between the facts and the law. And you say, in our case, clearly, the taxpayer's reasons support reasonable cause because of this, that, and the other thing. Or the taxpayer's compliance history is great. In 30 years, they've never filed late. They've always paid on time, or whatever the case is. Now, it's important that in this section that you make it easy to follow. You provide headings. You let them know what you're talking about. Call back to the factors and the facts. Because in this analysis, what your goal is not to convince the IRS agent, but to convince their manager to approve the reasonable cause, that you meet the criteria. The reason I say you're not trying to convince the agent is because in my experience, agents at the IRS, it's not their money. They're mostly good people, and they just want to help. And if it was up to them, they'd approve every single case. But they need to have a write-up that's going to be approved by their manager, that's going to show that they did their part and that they, did enough. And what you're doing in your reasonable cause letter is you're giving them ammunition. Do their write-up for them. They can copy and paste your letter, put it in their format, and put it on the manager's desk for approval. That's the goal here. Now, what you need to include in a formal request for a penalty abatement is the penalty abatement letter, a Form 843, which is the official request to waive penalties, any relevant IRS notices, and any supporting documentation. Any facts that you have, if you can support them with documentation. If you're going to say somebody got sick, get a letter from the doctor. If you're going to say that they lost their job, prove it. Give them a termination or a separation letter. Do whatever you can. The more documentation, the better. The IRS loves paper. The more paper in their file, the easier it is for them to approve it. This is what a sample Form 843 looks like. Notice that it references a specific penalty for a specific period. You should fill one out for each period. Although if you combined them and if you just put multiple periods on one form, the IRS probably wouldn't complain much. But in our office, we always do a separate request for each period just to make sure that things don't get mishandled. The process for doing an abatement is you send the formal request to where you file the returns. You wait a few months for a response. One of two things will happen. Either your client qualifies for first-time abatement, and they'll give them first-time abatement, or they don't qualify for first-time abatement, and they'll probably reject your reasonable cause letter. They almost always deny reasonable cause letters. This is because when you are dealing with the lower levels of the IRS, they don't have any discretion. If they're 51% sure of something, they have to charge you 100% of the amount. It's a simple yes or no. They don't get to, quote unquote, split the baby. So only when you get to appeals do they get to consider, quote unquote, hazards of litigation. They get to say, well, I'm 51% sure that you should lose, so you shouldn't. So based on that, they should give you a 49% discount. So don't be discouraged if your reasonable cause abatement request gets denied. 9 times out of 10 they get denied. You have to always be prepared to take your case to appeals, because that's where all the magic happens. 9 times out of 10, appeals will grant at least part of your request. They'll at least give you something for your time. It's almost always worth it to take the case to appeals. And that brings us to our third and final polling question. Thank you everybody for joining today's webinar. Hopefully you found it informative and you know a little bit more now about the IRS penalty abatement process and about innocent spouse. If you have any questions, not only about today's content, but about anything else related to solving tax problems, please do not hesitate to give me a call. There's a number on your screen. It's a hotline I have set up just for accountants and attorneys to ask me tax resolution questions. Don't hesitate to use it. I'm always happy to help and give free advice to help you and your clients solve their IRS problems. Until next time, thanks for joining.